Jim Dudnick, your AllianzGI short duration high income fund is off to a really good start this year, up around 3%. You throw in a 5% yield on top of that, you're heading towards a pretty good year. So what's driving it?
I think it's really the fund's approach to really take a conservative approach to high yield, buy the type of issues that are not attractive to a total return high yield manager, but are attractive to us. So on a risk adjusted basis, we're buying lower volatility and really getting a higher coupon out of that. So as far as a fixed income alternative, it makes a lot of sense.
Are you finding yourself stretching for yield right now? Because even though rates have ticked up a little bit, it's not really that much.
No, the opportunity is still there to buy what we like and be consistent with our strategy. So it for some time makes sense for us to continue to do what we do best.
Now, the drop in energy prices also pulled down the high yield sector over the course of the winter. Where are you right now with your energy allocation?
So when you look at the energy allocation, or at least the sub-energy allocation within high yield, there's really one big driver of negativity there, and that's exploration and production. The U.S. shale, a lot of debt was raised to invest in shale projects, and we actually have zero allocation to that in our fund. Our energy exposure is to pipelines, really the transportation highway to produce the oil. Not the producers of oil, but the transporters of oil. So when you looked at the fourth quarter, high yield as an asset class was down 1%. We were actually up because we avoided that subsector.
Nice move. So where are you finding yield right now?
So it's really in the kind of meat and potatoes double B, single B issuance that's in there. So companies that are free cash flow positive, companies that are enjoying a moderate growth environment in here and are really increasing their earnings over time.
And the default rate, I guess if the economy keeps going along well, you're not that worried about that?
We think defaults are known in the high yield market. There's going to be some. I think specific, as I mentioned, to the exploration and production companies, you can see a tick up in there. You're already starting to see some issuers that really don't have the commodity catalyst to keep their businesses going. They're going to default. Fortunately, with our strategy, we're not trying to own those.
And speaking of issuers, let's talk about issuance. Are you going to see a lot more paper hit the market, especially before you see the investment bankers head to the Hamptons?
You know what? I don't think so. I think year to date, we've been surprised by the lack of issuance in here, but that's really because there's not a lot of near-term maturities that need to be addressed. And that means that the high yield market's in a pretty good shape from a maturity schedule.
And then finally, is there a seasonality to high yield? Yes, we got sold off last winter. When investors look towards the summer, what should they be thinking about?
Well, I think you should look across your fixed income portfolio. Big investors are really at an angst right now of trying to accept what lower rates there are. You have the Barclays Agg, which is the benchmark for most core bond funds, yielding 2.2%. And if you have a poll, which recently come out to most investors that are saying, well, are your fixed income returns going to be positive or negative over the next 12 months? 55% said negative, which is shocking to me because there's very low inflation across this country. There's very low projected economic growth. Those are the real drivers of negative fixed income returns. So I think there's angst right now about accepting a 2.2% core bond yield. Our fund gives a solution to that. That problem of generating enough coupon and enough yield. So I think you look forward to staying with the strategy and staying with the right type of high yield corporate paper. I think you'll do well.
All right, thanks a lot, Jim.
Thanks.
And thank you for watching The Street.